Welcome back, traders, and we should have a great start to the week. President Trump shook markets late on Friday after surprisingly announcing 100% import tariffs on Chinese goods and export controls on key products such as the software, all starting in November as a countermeasure against China's recent curbs on rare earth elements. However, during the weekend, the US president used a more softer tone against China, so that helped the US dollar to start the week with a soft positive gap. However, in the absence of any data releases, the focus will probably be on Fed commentary this week. Powell and other key policymakers such as Waller will be speaking on Tuesday. Now, outside of the US, UK employment and GDP growth figures will be released on Tuesday and Thursday respectively. And of course, gold will remain on the spotlight as the precious metal keeps unlocking new all-time highs. So at this video, I'm going to closely watch to analyze dollar yen, pound dollar, and gold, and starting first looking first at dollar yen, well, we can see that the dollar had a pullback late on Friday on the back of President Trump's tariff threats. It fell from 153.26 and towards the 151 territory, but as we said, it started with a positive gap today, back within the 152 area. Well, from a technical perspective, we can see that the market is still very close to overbought levels, so that downside move over here may face an extension unless Fed speakers use a more hawkish tone and put additional rate cuts into question. Note that futures markets are pricing 2 more rate cuts by the end of this year. The central bank could cut interest rates by 25 basis points this month, and also another one could be delivered in December. So it will be interesting to see whether they are thinking to cut interest rates further, or whether they are considering any aggressive reductions. Following some cautious commentary recently when Powell said that there's a difficult trade-off between inflation and the weakness in the labor market. So it remains to be seen whether policymakers will keep voting for additional rate cuts. If that proves to be the case, if we face a dovish tone, then dollar yen could extend to the downside. Dovish commentary could add some pressure on the US dollar, likely driving the price towards the 149.37 region, where the 50% Fibonacci retracement level of this down leg is placed. And then below that, another key territory could come somewhere between 147.85 and 146.70. There are a couple of trend lines around this zone. So, and also we can see that the 250-day moving averages are within this region, adding extra importance. What is interesting here is that we do have a bullish cross between the simple moving averages, so that supports bullish trend continuation. Let's see if that happens. If for that to take place, we need a clear bounce above the 152.8 resistance zone, where this constraining line from April is placed. Then slightly higher than that, the 154.15 territory could be also another challenging zone, since there is a long-term tentative resistance trend line coming from July 2024. We need to surpass this in order to boost confidence and target higher levels such as the 156.70 zone. Now looking at pound dollar, well, UK data have been kind of showing some stability during the first quarter. According to expectations, the unemployment rate could remain at 4.7% on Tuesday. That's still high. It's still around 3-year high. So obviously we would like to see whether there is an extension higher, whether the unemployment rate will keep trending higher. Moreover, GDP growth figures have been also showing some stability in the first quarter. Expectations are for a slight improvement in monthly readings. So let's see whether the UK economy could face some progress in the second quarter, as well as the data are about August conditions. Now, from a technical perspective, we can see that the British pound has been on the back foot lately. It lost some ground last week, falling to closer to the 1.3255 level as the lowest since August. And looking at the technical indicators, we can see that the short-term bias is skewed to the downside. The RSI is below 50. The stochastic oscillator is also not showing a clear upside reversal, so that keeps the risk to the downside, particularly following the rejection near the simple moving averages at 1.3450. That could cause a bearish extension to the downside, though a critical zone could be found around the 1.3145 and 1.3180 zone that coincides with the 38.2% Fibonacci retracement level of this up leg, and not far below that. Basically, we also have the 200-day moving average within this zone, so that could be we could see some strong consolidation here before we reach the 1.3050 territory. No, the upside, if in the case of positive surprise in the data, the price could retest the 1.3450 zone. A clear break above this could boost sentiment, driving the price, adding more gains towards 1.3585 that has been a double top region back in August and July. So if we successfully overcome this, that could drive us straight to the key constraining zone of 1.368 and 1.37, which we need to break in order to upgrade the short, the medium, and the long-term picture. And finally, looking at gold, well, gold is trading at fresh all-time highs. Today, it marked a new high a couple of minutes ago at 40,179. We had a small pullback last week, but trade war risks boosted buying appetite, and so we are now closer to the 4115 and 4140 zone. That's a key constraining zone to watch since it includes the 261.8% Fibonacci extension of this downfall coming from April. If we move even higher, then the 4200 and 4300 psychological marks could be the next targets. However, if we look at the technical indicators, we do have overbought signals in the market. The indicators have been trending within the overbought zone for more than a month. Particularly, the RSI over here has been above 70 for more than a month now. So that makes the market sensitive to any downside movements, to any bearish news. If we see a pullback, then the 3970 could add some support ahead of the 38.90 zone, where two key support trend lines are placed. Then below that, all the attention will turn to the 3735 zone, where the price found support back in September, a break of which could take us could cause another sharp decline, probably towards the 50-day moving average, currently seen near the 3600 level. So that's everything I wanted to share with you guys. I hope you liked my analysis. If you did, please subscribe in this channel and like my video. We'll be back next in a couple of days for more technical analysis. Thank you for watching, and see you next time.